Hi there, folks. This is Sean Broderick for the Oxford Club Resource Report. There have been important fundamental changes in the gold market this past week, and we're seeing it reflected in gold and miners. But the best plays for a gold rally aren't in gold, and I'll show you all that and more in 3 charts. First, let's talk fundamentals. We know the Chinese are buying gold hand over fist. More interesting is that the official efforts to suppress gold buying in India don't seem to be working out all that well. Perhaps it's because India's currency, the rupee, is falling so hard so fast that if this was happening in the US or Europe, it would be called a crisis. The rupee is down more than 15% since May. This, in turn, is stoking inflation in India, particularly food inflation. What do people do when they worry about inflation? They buy gold. And sure enough, gold is holding its value very well against the rupee. So, with the Indians and Chinese buying gold hand over fist, sales of jewelry, coins, and bars will reach as much as 1,000 metric tons in India and China in 2013, and that's valued at a combined $86.7 billion. That's a lot of demand. The other important development is that ETF sales of gold are finally slowing down. In fact, over the last 2 weeks, the Spider Gold Trust, or GLD, has seen inflows. This is important because sales of gold by ETFs was the major driver in the waterfall sell-off we saw a few months ago. So, demand in Asia remains very strong, and the dumping of gold by ETFs seems to be emptying. That should be a recipe for higher prices. And let's look at the chart. The first chart tracks the GLD, which holds physical gold, up against the UUP, which tracks the US dollar. You can see that gold is zigzagging higher and is close to a breakout. The dollar, meanwhile, is near support, but can't find any of that traction in a rally. The weakness in the dollar seems to be driven by strengths in other currencies more than anything else, as Europe's economy is starting to turn around, and Japan is showing strength too. In any case, a weak dollar usually translates to gold strength. But how is this affecting mining stocks? Let's look at the next chart. This is the Market Vectors Gold Miners ETF, a basket of leading miners. You can see it enjoyed a nice rally, but it's coming up against overhead resistance. And the indicator on the bottom of the chart shows that the bearish trend isn't over yet. I would expect the battle lines to be drawn at that overhead resistance. I expect gold miners will push higher, but we could see some back and forth before that happens. So, if gold miners are about to run into overhead resistance, where else can we look for performance? My answer is silver miners. This chart shows the Global X Silver Miners, or SIL. You can see it is right at overhead resistance right now. What's more, volume is bullish and improving. I think this looks like a good entry point for a trade, and select silver miners should do even better. Remember to do your own due diligence and have a protective stop in mind before you buy anything. This is Sean Broderick for the Oxford Club Resource Report. Thanks for watching.